We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
There's a place where the gold runs deep. And when you strike big. Meet Nevada's fastest growing mineral claim holder in the heart of elephant country. Visit nevadaking.ca to follow the story.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Kevin Muir, author of the Macro Tourist newsletter and co-host of the Market Huddle. How are you today, Kevin?
Good. Great to be with you today, Tom.
Great to have you back. So I wanted to start by maybe have you highlighting some of the similarities that we're seeing in the market today and the dot-com bubble.
Well, geez, there's tons. I sit here and I'm staring at these electric vehicle ramps that we get, and it reminds me so much of the Linux ramps. You're too young probably to remember this, but in the dot-com bubble, we had a stage where everyone got excited about Linux and they ran these things higher. And, just even the Bitcoin, it's reminiscent of the fact that there's just so much money out there and it's chasing whatever is the hottest asset around, and it's just ramping it. And the one thing I will say that's different than the dot-com bubble was that the dot-com bubble, there was a lot of retail, but it wasn't as fast. This is really, really fast. And I guess I would attribute that to the fact that the world itself has sped up. Information travels faster. We have the Twitter, we have Facebook, we have email. We are all communicating. We're all watching the same things. So in the past, you would have bubbles that took longer to form. Now it feels like these bubbles form almost overnight and they go so fast. And that's where I would kind of draw the line in differentiating the two of them. So
you're a trader, correct, Kevin?
Well, I wear a lot of different hats. So, and that's probably one of my biggest problems when I'm investing / trading. And one of the jokes is always, what's the definition of an investment? It's a trade that's gone awry. And I do struggle with making sure that I identify the time period. So there is part of me that is a trader. Like, we're taping this after hours and I've been trading all day and zipping in and out of the market. But then there's also other positions that I've held that I've been holding for 6 months and I haven't looked at them and I just let them cook. So I am a trader and an investor, and I trade a variety of different timeframes, and I trade a variety of different products and asset classes.
So the reason I asked that is exactly because in a recent article, you're talking about these rolling bubbles and how they kind of exist everywhere right now. So are these rolling bubbles the consequence of today's monetary policy? And why are you so comfortable with commodities? Is it helpful to identify some of these bubbles with a momentum lens instead of a fundamental lens?
So I completely agree that is the way to trade these new environments, is to look for the momentum and be like George Soros, get on them, don't fade them, don't be trying to fight them. If you see a bubble forming, you buy it, just like George Soros. Having said that, why do I think that there's so many of these? And you touched on the fact that monetary policy. Yes, there is no doubt that in my mind, monetary policy has been one of the driving forces that has created these bubbles. And I say the piece I wrote recently was called A Series of Rolling Bubbles, but it was actually a follow-up to a piece that I said that I wrote 3 years ago that was called A Series of Rolling Mini Bubbles. And back then, what I had noticed was that there was all these hedge funds out there trying to chase whatever the latest kind of source of alpha was, whether that be, they think the US dollar is going down, so they're buying gold stocks, or they think that small caps are going up, so they're buying IWM. And it just kept playing over and over again. And that I saw them get a good idea. Someone puts it on, they tell their friends, they start buying it. It gets to be, what was a good idea gets more fully priced, but yet because they're all doing it and telling each other, they become convinced that it's correct and that the trade makes sense. And so whereas at one point it was cheap, it eventually becomes they're buying it because the action seems so great. And one of the things that I've been trying to tell my readers is you shouldn't be afraid to fade what I would call the FinTwit gurus or the hedge fund guys. Like, I can't tell you the number of hedge fund aficionados that have gone on CNBC and have breathlessly told me something and they've proven to be wrong. And I'm not trying to pick on them. Like, trading and investing is a hard game. But in this day of limited alpha, by the time you get a situation where a hedge fund portfolio manager is willing to tell everyone, he or she's already put on the trade, he's told all their friends, and it's getting later in the game. So I had noticed this kind of 3 years ago, that this was a constant kind of cycle that we went through. A trade got excited, it got hot, and then eventually it came in on itself. It got to a point where the hedge funds would get bored. They weren't allowed to take the volatility of a loss, and they just got rid of it and they pitched it. And at that time, I always thought, oh, the alpha is actually inflating these guys. And I used to call them, in my day when we started in the dot-com bubble, we used to say we sell to the dentists, meaning that when the dentist came to buy the stock, that was when you knew that it was fully baked in. And I kind of laughed and said that the hedge funds are the new dentists. And it's not that they're any worse. It's just that there's so many of them and it's very difficult. But now fast forward to today. And today I think is imagine that same kind of cycle, but now it's on steroids, meaning that not only do we have aggressive monetary policy, but we actually even have aggressive fiscal policy. And so we have a combination of the government stimulating from both sides, and we have this massive pool of savings that has nowhere to go. And when I think about the problem that people have when they're sitting there and they're managing their own 401ks, they're stuck. Like when I first started in this industry in the early 90s, you could go get a bond and it was yielding 5-6%. And that was pretty good. And if you had $1 million, you could buy this bond and it would make you 60 grand. Well, go figure out what that bond's yielding you now. So investors are faced with lower yields and yet the same requirements in terms of what they want to spend and how much they need for savings. So they actually need to save more and they need to, in some ways, get more juice. So there's almost an inherent short position in that there's not enough good assets for investors to buy. And so this goes back to why we have these bubbles. And like I'm a Bitcoin skeptic, and I think that it's a solution in search of a problem. And people will say, I'm a no coiner that doesn't get it. Well, I tell the story of I was actually one of the first in terms of out of the finance guys to start arbing this. The kid beside me told me about Bitcoin at $5, and I told him it was the stupidest thing in the world. And then a month later, he says, that thing you told me is the stupidest thing in the world is $50. And I said, oh, geez, and I said, if it's $50, it could be $1,000. So we started arbing it and mining it. And we actually at one point had so many Bitcoin mining computers in our office that we had to take them into our garage. So I'm not some no coiner, but I do believe that what you're finding is that these bubbles and these investment ideas, because there's so little in terms of actual good things to invest in, when a story grabs hold, when a story captures the imagination of the investing public, it can run way farther than anyone imagines. And I think Tesla is the perfect example. Tesla is one of the largest. I shouldn't say one of the largest. I think it's the largest company to ever get included into the S&P 500. So think about how quickly it has risen to that level of that size. And yet here we are, and we're putting it into the S&P 500. It's going to be the 10th biggest company or some crazy number like that. And investors, because they were looking for something to buy, they were just needed something that captured their imagination. They pushed it up. So going back to this, I think that there's lots of little bubbles out there, and there's lots of extremes in valuations. Now, I want to go back. One of the things you asked me is why then, if there's all these bubbles, do I think you should own commodities? And so there's been a dramatic change since COVID in the way our governments view economics. And up until COVID, we tried to solve all of our problems with solely monetary solutions. So if you think about the great financial crisis, or let's even back up. Let's back up to the dot-com bubble. Dot-com bubble bursts, and what does Greenspan do? He lowers rates, and he leaves rates low. The great financial crisis bursts, or happens, and what do? They lower rates. They lower to zero, And even then, it doesn't work. Zero doesn't work. So what do? They do quantitative easing. Each time they were faced with an economic slowdown, they met it with monetary easing. And that was how we thought we should run the economy. That was what all the ivory tower kind of academics told you. That was what governments believed. It was just seemed to be what everyone accepted as true. But if you think back to the great financial crisis, like think about the absurdity of having a collapse in credit and the government, when everyone else is cutting spending, the government also decides to cut spending. Now, you might say, oh, no, Obama spent all sorts of money, cash for clunkers. Those programs were actually very short-lived. And if you look at the discretionary spending of the federal budget, up until the great financial crisis, there was 3 years where it actually had fallen year over year. And that was 64, 68. I think it was Kennedy and then Johnson with the wars. And then it was 96, it was Clinton. But every other year, real spending on a discretionary basis went up. Okay, now comes great financial crisis. We get this problem. It looks like we have too much debt. And so what happens is the private sector stops, retreats in on itself, and the government, instead of doing counter-cyclical spending, actually engages in the same pro-cyclical cutting. And so that's why we had so much monetary stimulus in 2008. Everyone talked about this was the worst recovery that we'd ever had. Well, the reality was that the government was also cutting spending at the same time that the private sector spending was cutting spending. So Bernanke was forced to do extraordinary measures, and he was begging everyone to do fiscal. But back then, no one listened because there's that famous book about Carmen Rogoff and Reinhardt and Rogoff, and this time is different. And they talked about the fact that if government hits, 100% of debt to GDP, there's a financial crisis. So therefore, we have to do everything we can to make sure we don't hit that. Now, let's contrast that to recently when this COVID crisis hit. All of a sudden, governments just opened up their checkbooks and actually started spending. And I think the big surprise was that in the March lows, when everyone was so bearish, I was sitting there and I was saying, listen, you should be careful because the governments, you'll be surprised at the hole they can fill by creating spending, by creating those dollars into existence. And that is what is in essence happened. The governments have started to spend money into existence, and it's opened up the whole way we think about the economy, the whole way we think about how markets and how society functions. Now, you might believe that this government spending all this money is going to end badly, and that is a long debate. We can have it another time, but the reality is that's what they're doing. So you ask why I like commodities. And the reason I like commodities is that I believe that the government's spending means that our actual real economy, like Main Street as opposed to Wall Street, is going to do much, much better coming out of this next recession. And we're going to see the world global growth explode higher. I foresee a situation where we actually have a 1920s style expansion or just like a bubble almost, if you will, because governments are going to be incented to go out and spend all this money at the same time that we're leaving rates at zero. And so you ask why I like commodities. I like commodities because in that environment, we are eventually going to create inflation. So I really believe that. And I don't think we're going to create inflation because of quantitative easing or easy monetary policy. I believe we're going to create inflation because the government is doing fiscal spending. And when that fiscal spending eventually starts crowding out the private sector, and that's when we'll get the inflation. And if we think about it, what do you want to own in a period of inflation? I want to own real commodities, real assets. So the last thing I'd want to own is bonds. Bonds are going to get crushed, I believe, coming, during this period. And I believe the commodities will be the asset that you should want to own.
So, Kevin, can you share with us a couple of differences between fiscal stimulus and monetary stimulus, just to try and, let's say, really define that clearly so that we can all understand it?
Sure. So let's take a normal environment where the interest rate is set by the Federal Reserve, and let's just say it's 3%. And then all of a sudden we get a situation where a recession occurs and the government wants to stimulate the economy. And mostly, don't forget that the Federal Reserve, they have two mandates. It's to maintain, the value of the dollar or, keep inflation in check. And they interpret that as a 2% target, but that's not actually written there. Their actual mandate is to keep, it's something like to maintain the value of the currency or whatever. But anyways, so they go and they decide to cut rates. And so they cut rates because their second mandate is to maintain full employment. Right, it's right there. They're supposed to maintain full employment or as close as they can to full employment. So they cut rates. The thinking about cutting rates is that if you think about it, like cutting rates is great. You go all of a sudden, you as a homeowner, you're sitting there and you could think, oh, you know what? I can afford more house. I'm going to go buy a new house, or I'm going to buy a new house. You're someone who hasn't bought one before because all of a sudden it's become cheaper because you can finance it at a cheaper rate. Or you're a corporation and all of a sudden you think, I was going to build a factory and now all of a sudden it's become cheaper. So I'm going to build that factory. So through a variety of different mechanisms, this stimulates the economy. And actually, as an aside, one of the reasons they think it stimulates the economy as well is something called the wealth effect. So actually, Bernanke will talk about the fact that they believe that raises the price of stocks and therefore people feel richer, so they spend more. Okay, so that is monetary stimulus. Now, there's lots and lots of problems with monetary stimulus. The first and easiest one is that at zero, it no longer works, meaning that when you get to the zero bound, you can't cut anymore. And if you do cut, it actually becomes, I think, negative for the economy. So that's the first thing. Then the second thing is, like, if you think about the way they've gone through it, like the economist's way of thinking, instead of thinking about it their way, let's think about it from like a business person's standpoint. If you're sitting there and let's just take, for example, Nestle. Nestle is a European company and they have negative rates in Europe. So let's imagine they go and the ECB lowers rates from minus 50 basis points to minus 100 basis points. Well, all the academics will say, oh yeah, now all of a sudden Nestle is going to go and they're going to build more factories and they're going to do stuff. But let's stop and actually think about how it works as a CFO of Nestle. You're sitting there and the cost of building your factory has become cheaper. And in fact, they'll pay you to build a factory, meaning because they'll give you negative rates so you can borrow and then pay back less. But what happens if there's no one to buy your product? It doesn't matter that you have a very low interest rate to build your factory. The reality is that you have nobody to sell your actual product to. And in that case, the CapEx spending will become disastrous. So on a risk reward basis, it becomes much, much scarier to actually go out and do that CapEx. And interesting, Tom, is that one of the things is that in the 80s and 90s, there was a study by Goldman Sachs and they looked at CapEx spending versus the interest rate. And so what they found was that it was negatively correlated, meaning as the rates were lowered, people spent more on the CapEx, meaning they went and built factories, just like the economists say in their textbooks. Well, what happened in the 2000s and the 2010s is they actually became positively correlated, meaning that as they lowered rates, they spent less. And it makes sense because as rates went lower, it meant the economy was worse. And therefore, it meant that there was more chance that nobody would be there to buy their actual product. The other thing to think about is the fact if you think about it from a saver's point of view, think about it. You're somebody that's sitting there, you're 45 years old, you're working, you're trying to save. And why are you saving? You're saving for your retirement. You're saving, to put kids through school or whatever. Now, all of a sudden they go and they lower rates. They might even put rates to negative. Well, what does that make you do? Do you think that makes you spend more? No, it actually makes you save more because now your savings, your actual portfolio is going down because you're earning a negative rate. So ironically, even though they want people to spend more by lowering rates, they actually create a situation where people have to save more. So governments are kind of just being out to lunch with this whole policy of how monetary policy works and how much it can affect the economy. And so now let's go back to fiscal. Fiscal is much different. Fiscal is basically the government spending more than they're taxing and changing the amount that they're putting out into the economy. And it's simple as that. And we see it right now that various governments are running 10, 20% of GDP as deficits. And that money is going out. It's the government's debit, but it's the private sector's credit, and it's going out into the system. And that is why our economy has not plunged into the abyss.
And that's why the debt won't necessarily cause the implosion and collapse that people think it will, right?
Now, this gets into a little bit of MMT, which is modern monetary theory. And this is a little trickier. And what I like to kind of walk people through is, let's think about Japan and the Bank of Japan, because it's been viewed as the poster child of MMT gone awry. And Japan is anything but MMT. They're actually just basically an example of extreme monetarism. And the reason that they're different than MMT, and I'll just briefly explain this, is that MMTers believe that there is no financial constraint to how much a government can spend. They don't believe that there's some like Carmen or Reinhardt and Rogoff when they said there's 100% that causes a crisis. They believe that there is what's known as a real resource constraint, meaning that eventually as the government spends too much, they will compete with the private sector and they will create inflation. And that is the true kind of constraint that a government is facing, not this financial artificial constraint from how much debt. Now, you might say that makes no sense. That debt has to be paid back. And it's kind of difficult to get your mind wrapped around. But one of the ways that I like to think about it is, let's just take the Bank of Japan and the government of Japan. The government of Japan owes 250% of their GDP outstanding as JGBs. So you think, oh my goodness, look at this. This is all going to have to be paid back at some point. But then you realize that the Bank of Japan owns half of that. And you start to think, well, wait, if one side of the government is long and the other side is short, like what would happen in the middle of the night if they just flatten that? And I hear all sorts of pushback, and I contend nothing would change in the real economy. Mm-hmm. Yes, maybe there'd be a crisis of confidence and we could go through that. And I think ultimately that would also get sorted out. But I think that if they just did it, it wouldn't flat. So then the question is that debt, like we're getting all upset about this 250% of GDP and it's going to end badly, but is it really? Because I just showed you how it's really 125% of GDP. So then you're going to say, but wait, that means that the government can spend to do it all again. And I say, yeah. And then they go, well, that's not going to work. Eventually, that's going to cause a problem. Eventually, you're going to create inflation. And I would say, yes, bingo. Yes, you are going to create inflation. And that is the problem. That is the real issue about where governments can stop doing fiscal stimulus, is when they create that inflation. So let's go back to my idea about commodities. The MMT folk will tell you that the governments will be able to control that inflation when it comes. So this is my only actual sympathy I have for the MMT critics, is that they say, bullshit, there's no way the governments will be able to stop spending once they start. And I am sympathetic to that idea, that it will be very difficult to withdraw the fiscal stimulus. You know, the central bank is an independent body that can push rates up and down, and they don't have to get elected, really. They choose what they think is best. Governments need to get elected. And I think you're going to find that once they get a taste of this fiscal stimulus, it will feel great. It will work really great at first. But eventually, and probably more quickly than everyone expects, we will start to hit inflation, and it will cause constraints. They will hit that real resource constraint. And instead of pulling back and instead of increasing taxes like MMT says, they're going to just continue to do more. So that is why I believe that you need to own real assets, is because I think we're about to go through a period of 5, 10, maybe even 20 years of inflation. And if we think back to most people's investing, you know, since they've been around, all but our oldest grandparents have only experienced lower and lower interest rates. You know, interest rates peaked in 1981, and they've been steadily going down since then. And it's been a case of basically inflation peaked in 1981 and has been going down since then. We've had disinflation. Well, I think that whole trend is about to reverse. And I think we're at kind of the 1981 period of a change in trend. So just like when Volcker came in and he raised rates and he controlled inflation, and people forget this now, but back then there was lots of people who didn't believe he would be able to stop inflation. there was whole groups. There was a famous strategist called Dr. Doom, and I think his name was Kaufman, and he worked at Salomon Brothers. And he went around talking about how inflation was systemic and there was no way they were going to ever get rid of it. And Volcker came in there and he changed it. And those people stayed bullish on inflation the whole way down, even though inflation kept going lower and lower. I think we're going to have the exact same issue in reverse. I think there's lots of people have seen 40 years of inflation going down, have seen 40 years of interest rates going down, and they're going to be shocked when those both start to head higher.
Kevin, do you mean when you're saying inflation going down, the rate of inflation per year going down?
That's correct.
Yeah, we're talking about inflation going down year over year, not asset prices coming down.
Right. So we had disinflation over the past 40 years. And that meaning that like in 1981, inflation was 13% or 14% or whatever. And yes, it's gone up and down a little bit, but on the whole, you go draw it, you look at it, it's gone from the top left to the lower right.
Right. So given all of the Fed's responses to the crisis, this makes you say that Trump is actually by far the most pro-MMT president the U.S. has ever had, right?
Yeah. So I love that. It gets everyone really mad. If you think back to Trump, he was 8 years into an economic expansion. And what did he do? He did fiscal stimulus. Now, everyone thinks that MMT is government spending. And the reality is that MMT doesn't actually have a definition like that. What MMT says is that the government can do fiscal stimulus up until they get inflation. And fiscal stimulus can be in the form of government spending or through tax cuts. And if you actually go look at one of the fathers of MMT is a fellow by the name of Warren Mosler. And Warren Mosler is a very famous hedge fund manager who did a lot of work in terms of trading bonds, and he traded the short end of the curve. And he really understood the plumbing about how the economy works. And he's the first one to say, the reality is that the left have kind of grabbed hold of MMT because they want to achieve these goals. But that's not really what MMT is all about. MMT is a framework for understanding how the economy works. And then the political decisions that each society chooses based on that framework is what people are confusing as MMT now. So going back to President Trump was one of the most MMT presidents that we've ever had because 8 years into an economic expansion, if you go think about a Keynesian would tell you at that point you should be paying down the deficit, okay? The person that studies Austrian economics will be telling you should be raising rates because, you have to get the creative destruction. You need to have the government shouldn't have rates so low because let's just face it, they always want the things to be expensive that way to make sure that the assets that are actually getting built meet a certain hurdle. Anyways, long and short of it is everyone would be telling you to do something different except the MMTers. And the MMTers, and so let's go back to Trump. What did he do? He went and he did fiscal stimulus 8 years into an economic expansion. They asked him, listen, why are you doing this if the economy is so good? Why are you asking for lower rates if the economy is so good? And he responded, because there is no inflation, which is exactly what an MMTer would say. They believe that the government should do fiscal stimulus until they hit a point where the actual real resource is constrained. And that's exactly what Trump did. Now, it gets more complicated because it ends up being that that's a political decision about how you do that fiscal stimulus. The fiscal stimulus that he chose ended up going to corporations, and it ended up going to, on the whole, people of more affluent means. The trouble about that is that it doesn't actually go into the real economy. Let's just take the corporations. A lot of the corporations, they didn't go and spend it on a new building. All they did was buy back shares. Even the people, when you think about it, if you give somebody that's making, minimum wage rebate, then they will most likely spend it. You give somebody that's worth $100 million some more money, chances are they'll just save it. And so it ended up being that although Trump is the most MMT-like president we've ever had, the political choices that he made probably didn't result in the most optimum economic solution.
Right.
And so anyways, going back to this, I think the whole world has become MMT. There was a joke that they said we're all Keynesians now. Well, we're all MMTers now. And you see it. Even Yellen, I was looking at Janet Yellen, who used to be the chairperson of the Federal Reserve. She used to strike me as someone who was very hawkish in terms of balancing the budget. She talked a lot about the eventual, like, leaving this burden to our kids. And she was the mainstream economics the whole way. Well, I just watched a speech she gave and she's thrown it out the window. She has become much, much more MMT-like than she's ever been. And this is my point, is that the COVID marked a sea change in the way that most government officials and even the public thinks about debt and thinks about spending. And the real challenge to investor is to be able to understand that this has occurred and to realize that there might be profound ramifications to our portfolios. And just think back, I mentioned it, but think back to March. Right now it's easy to forget that back then things seemed so bad. But let's think about how scared everyone was about the stock market. People were selling like nobody's business. They were all short. Everyone thought it was going down. And yet here we are, a scant 9 months later, and we're rocketing to new highs.
And this is exactly where your new phrase comes from. The old one was don't fight the Fed, and your new phrase is don't fight the fiscal, right?
Exactly. That's great. I've forgotten about that. I said that. You're absolutely correct.
So as you're speaking about Janet Yellen, I believe she's being announced as part of Biden's cabinet, correct?
I believe so, yeah. I think she's the Treasury Secretary, if I'm not mistaken.
Right. So that's why she's been in the news. So, if they're taking that type of attitude, what considerations of a Biden presidency is going into your thinking about inflation?
So Biden for a long time scared me because he was actually the most old school politician out of the bunch. And I think it was before COVID. I remember him telling people that he was going to raise their taxes. And I was just like, he just doesn't get it. And I was really concerned that he was going to basically fall for what the Republicans do to the Democrats all the time, which is, they tell the Democrats that they can't be spendthrift and they can't spend everything on their watch. And then when the Republicans take over, they spend more than they've ever spent. And I'm not trying to be partisan. I'm just saying that when you're thinking about how that affects your markets, you have to take that into account. So I was worried that Biden was going to fall for that. And it was going to be that was a return to the old ways. I'm pretty sure that even Biden has put that aside, and that the reality is that all governments have accepted this new kind of reality. And one of the things that I worry about is that when I'm watching governments, I'm really worried that come next summer, when we get all of the vaccine out in the public and we're seeing that the economy takes off again, how quickly do we return to this trying to balance the books attitude? And if we do, then I might change my tune in terms of how I should position my portfolio. But for now, I don't see that. And in terms of your question, in terms of specifically Biden, how do I set it up? I view Biden as just the same as everybody else, in that all these governments seem to be going that way. Even the Germans, who are notorious for not spending, seem to have, lightened up and started to do fiscal. So I'm not really treating Biden any different than anyone else. I just think that it's been a sea change across all politicians.
So I want to go back to something you were saying earlier, Kevin, about, let's say, copper specifically. So how do you think about investing in copper and the energy metals, and how it's comparable to, let's say, the picks and shovels of the gold rush?
Okay. So yeah, copper has been one of my favorite trades. And when I look at the electric vehicle bubble, I can't bring myself to buying whatever the new SPAC is, or the new hot Chinese EV company. And it's just maybe just that I'm too old and I've seen this happen too often. But it seems to be that it's rare do those companies that get all the excitement about them end up being great investments. And actually, I'll tell a little story that I actually forgotten about, but it just reminded me of. There was a period in, I can't remember, it was the late 70s, early 80s. Anyways, Norway found oil off their sea. So they were offshore oil, and the technology had come and they found this huge play. And someone hit it big. Can't remember the whole story, but someone hit it big. And the next thing you know, everybody is out there looking for oil. And these stock prices start going to the moon. That's just crazy. It's a full-on mania, just like electric vehicles that we see. Well, the hero of my story here is a very wise, shrewd Norwegian investor. And what does he do? He doesn't go and look at this and say, I got to go find the latest hot company with the best piece of land. He looks at this and he kind of thinks it through, and he goes and he starts buying all the Norwegian art he can buy. And he's just lifting offers. He's buying it and amasses this monster art collection in Norwegian art. And the reason that he had done this was he realized that there was going to be a massive amount of wealth created from all of this offshore oil. Mm-hmm. And eventually that would come back and they would need something to do with it. And they would go buy art. And he realized, he thought through kind of 2 steps down the line. And he said to himself, I'm not going to go chase the bubble. I'm going to go buy the next thing they're going to buy. So he ended up buying, like, literally almost cornering the art market. And then the art market exploded from there. And it was a great trade. And it's always the joke about, in a gold rush, it's not the miners that make money. It's the people selling the picks and shovels to the miners. Mm-hmm. Meaning that the companies that provide the materials that the people are rushing out to do, the stuff that's needed for that, those are the people that are actually going to make the money. So going back to copper, I kind of look at this EV bubble much like the Norwegian offshore bubble. Like, it's going to be really difficult to figure out who's going to win. It's going to be, the prices are all gone up in terms of they're all fully priced in, or they become fully priced really quickly. I'd rather own the next derivative, something that they're going to need or something that's going to be a consequence of it. So in this case, it's more like a pick and shovel in that it's an amazing amount of copper goes into these cars. And as we move from a gas or a fossil fuel based society to more of an electric society, we are going to need more and more and more copper. It is shocking how much more we're going to need. I remember I had this guest on one of our shows, and he told me that he said, I can't remember the stat exactly, but it was something like the UK had a goal to make all their cars electrified by 2040 or whatever it was. And he said, if they're successful in their goal, they're going to need 200% of the world's cobalt, 150% of the world's lithium, and 35% of the world's copper. And this was just the UK. Forget about the rest of the world. So I look around and I see all this, rush to EV. And I just realized that the amount of the materials that we are going to need that's going to go into these is a no-brainer. We're going to need tons of copper. And then when you combine it with the fact that I believe we're about to hit inflation, owning a real asset like this is just another piece of the puzzle. And then combine it with the fact that we basically have had the past, ever since the kind of commodity bust, that there's been a lack of spending in terms of mines because nobody was making any money for the longest time. The supply is limited. So I just looked at this and I said, you know what? This is one of those trades that you should just buy it and you should put it away. So that's what I've been doing. I've been doing my best. It's hard because it's been actually it's worked so well. And even today I saw it going up and I'm like, oh God, I got to just try not to look at it because I really believe that the mistake will be selling it too early.
Yeah, that makes total sense, Kevin. So one of the last kind of things I wanted to touch on here, and it's kind of a debate that we've been having back and forth on the show a little bit. Do you think that cryptos are another sign of an asset bubble that is being inflated by the Fed that isn't necessarily a stable or sustainable one?
So that's kind of a tough question because let me rephrase it a little bit.
Okay.
Do I believe that society has relied too much on monetary stimulus over the past, especially the past decade to try to get their economy going, and in the process made it more difficult and created a more fertile environment for these types of crypto bubbles? Yes, 100% agree. Mm-hmm. And the other thing I like to ask people though is so what's the alternative? Well, I always think it's funny when people start talking to me and screaming about the Fed and stuff. And then I go, so what's the alternative? So you're telling me the Fed should raise rates? The Fed shouldn't buy these things? Let's think back to the COVID crisis. There was no bids. I can tell you that would have created an extreme amount of pain for our society and would have been extremely destabilizing. And so it's easy in hindsight to say, oh, you know what, they did too much. That's why there are all these bubbles and stuff. But I do believe that society, we've chosen to rely too much on monetary stimulus. And that's really what I'm upset about. And in terms of like, do I think that the Fed should cut back because they're seeing crypto? I don't think the Fed can afford to. And then even more importantly about whether, my opinion about what the Fed should do, my opinion is irrelevant. It doesn't matter. And neither is yours or anyone else's. The reality is you have to think about not what should be done, but what will be done. And I get frustrated so much because I see these guys, they get on to FinTwit or they get on some show and they start talking about how it would all perfectly be arranged. And I go, yeah, you know what? Maybe they're right, but that's not how it's going to work out. That's not where we're headed. So I try to ask myself, forget about what I think should be done. Ask yourself what will be done. And when I look at it, I think there's very little chance that the Fed is going to pull back on their stimulus. And in fact, I would argue, given the fact that we are going to have a tough winter in terms of from a virus point of view, as we try to bridge the period between now and when the vaccine finally rolls out, I think we're going to have a tough winter. And if I was at the Fed and I was thinking about stuff, I would overshoot because I think that the consequences of undershooting are way worse. So yeah, in the process, do I create a bubble? Do I make Bitcoin go to the moon? Yeah, sure, maybe. Maybe I contributed to that. But I would rather do that than have, some family go without food or get kicked out of their house because the housing market's collapsed. And I think that that's the risk reward trade-off that you have to realize is that it's almost like a war. In a war, nobody stops and thinks about, I'm worried that we're going to create inflation. They're like, we got to do this. It needs to be done. And I think that the Fed is very much in that mindset of this is like a war. This is something we need to do everything we possibly can to get our society through this difficult period. And we'll worry about the consequences later. And so when I think about the Fed's reaction function, I think, yeah, they're going to cause more bubbles. And that's back to my point is that there's going to be, we're not just going to have a series of mini rolling bubbles. We're going to have a series of kind of full on rolling bubbles because the Fed's going to continue to do too much. But I think that they have no other choice.
Well, Kevin, I think that's an excellent place to wrap up. It's interesting to see the way that you look at these different pieces of the puzzle and put them together from, let's say, an MMT lens. And it gives us another great perspective. Of course, we can find you at The Macro Tourist. That's a great newsletter that I have the privilege of getting to read. And also at Kevin Muir on Twitter. Is there anything else you'd like to say as we wrap up here, Kev?
No, it's been a pleasure chatting with you. Thanks for all your support, Tom. I really appreciate it. And thanks for everyone for listening to me.
Thank you, Kevin. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.